Hi, this is Jeneen Poole with Villa Home, and we are back with the dynamic duo, Batman and Robin of the lending industry, Miss Tara Milam and Randy Milam. So today we are going to kind of take a look at what the market is doing and just what we can expect in 2025, how to make homes pre-existing homes more affordable when you come down to purchase it, because we have new construction, but that's not all that's out there. There's pluses and minuses to both sides, so we want to make sure that you guys know how you can purchase the home you really want and just kind of dive into the industry with my dynamic couple here that can tell us everything about the lending industry. They are the experts. So I'm going to give it to Randy and let him dive into his market minute.
So, the rates, there's a lot of talk going on about rates. And we feel with, some of the current policies that they will bring down rates, but that's not going to be, all predictions 18 months to 24 months. It just takes time to slow the economy down, is what they've been working on for 3 years. And once the economy has slowed down, and we're at that point, and that's why they raised prime in the beginning, is because when you have a red hot economy, by raising the rates, it slows it down and gets it balanced back out. Your demand and your levels just get back out. So that's what we've been doing. So as everybody talks about a lot of stuff around election year, this has been the goal for 3 years, is to slow the economy down. So you can't have a growing economy and trying to slow it down. They're trying to keep unemployment low as they slowed it down. That would be considered a soft landing. And the Federal Reserve, it handles this, not an administration. And so that's been their goal for a while. So that's what we're trying to get to the end. Now, when we get to the end, and that's when they start lowering the prime, and then we balance out, and then you'll see some rates start to fluctuate down. And the goal is to get back down to our 2019, 2018, where the 10-year yield was at 3.84 to 3%. And right now it's about 4.62 on a yield space. But that's what they control, and those are the goals. But it's we've had fluctuation already right now. I mean, you always have plus and minuses, and the market comes out. Today, durable goods came out, and that statistic came out just fine after they removed some stuff. So they were happy with that. So the market is staying unchanged. In the last couple of days, we had a big sell-off due to Chinese AI that came out, DeepSeek, and versus our AI. But then that'll adjust itself. So there's plays every day. So, but as a long-term scenario, I think it's about 18 to 24 months. And I think the Federal Reserve is doing everything they can. Well, for the last 36 months, they've done the best they can to slow the economy down, to get the inflation out. And I think we'll start feeling the effects here soon, but it's going to be a minute.
Okay, so you're saying that realistically, we can expect rates to come down to something that's a little more affordable within about 18 to 24 months.
I think that's a realistic time frame, and
Okay.
not to be too aggressive, or it's a good prediction.
Okay. So what do you consider the a good rate?
If we go back 2018, 19, we're low fives, high fours.
Okay.
Uh, and I say that so because if everybody's listening, the rates are based off the 10-year Treasury yield. That yields a return for people's investments. So once it gets below a certain number, if we don't get for investors to invest in our bonds, which is America's stock. So there's a give and take. So you go too low, nobody's investing. So every economist thinks, okay, a yield is 2.84. That's pretty good. If you look at right now, CDs, cash, a return on your investments are about 3.25. So that's a good yield on people's investments. And that will put us at a rate of the low fives, high fours, depending on program, down payment, and credit score. So I'm talking a very general, broad scope.
So let me back up to one thing you just said, because I just got to drive this home. You said that a good rate is around fours, low fives. So you also said that when it goes too low, No one's really buying, no one's investing. So if I'm understanding that, so the days of a 1%, 1.9, 2%, 3% interest rate, those aren't really the days we want to be in, and we really shouldn't be looking for that. Because if I put it in my understanding, that means my eggs are going to be skyrocketing. Am I putting that right? I'm not going to ever be able to have a scrambled egg again.
Well, that's more on the energy side, I
Okay.
think those. And so but it's called core inflation, as it's been referred to as, the table talk, which is fuel, food, and utilities. And that inflation is still up there. So once that comes down, it'll have an effect on everybody. But that's how we're going to get rates down. Is that everything has to come down. Everything's been up for a reason, to slow the economy. And when the economy levels in, the supply and demand levels off, then that's when you see. But we have to get energy costs down. But I wasn't really referring to that. I was just
Okay.
referring to a very general statement of what everybody's predicting, how long it's going to take. It has to get out of our system. No, and go back to the answer. There's a 10-year yield, which is our America stock. It's like anybody's stock. If it's not performing, you won't get people to invest. And there's a point of it's too low. How it got below is during pandemic, where Congress voted on the CARES Act, which bought our own stock. That was their only maneuver. They were spending something like $88 billion a quarter to drive down the price of the 10-year yield, and they drove it down to 0.2. That's how we got those rates. And when that CARES Act ended and that money came out of the Treasury, rates went back up. Now, the long term, or the talking points were wars and stuff, but a lot of it had to do with just the CARES Act ended, and that money of buying 10-year treasuries ended. And then so then it was going to go up, and that was in February of 22 was the last partial payment to the Federal Reserve on our 10-year note. So that's where rates went up, and then everything else happened. But that first little spike that everybody saw, from like 2 3/4 to 4.5, and it went real quick to 6. That was because we were coming off. We weren't buying our Treasury notes anymore, so we removed all this cash. Now that's how it all happened. So we have to have a global pandemic. We have to have a Congress to sign off on buying our own Treasury bills. That's what the Federal Reserve. But to summarize that, why did they do that? Because me as a residential lender and you as a residential realtor are 16% of our GDP. So when we shut down the economy, the only maneuver that the Federal Reserve had was, hey, let's do this, because our industry houses trucking, wood, cabinets, everything, furniture. And that's why they started with us, and that was the only maneuver they had. It's been done a few times in different administrations. It wasn't magical, as I say. It was an actual maneuver that they had that start the economy, and they did a really good job bringing it back. And then we had some inflation due to, all kinds of different reasons. But now we're fighting that. But that's why prime got raised to slow the economy down. So we're on path. This has always been on path. Now there's a lot of political environments that get involved, but the Federal Reserve is independent to the administration. So if you follow Powell, but this has been the whole technique: raise prime, slow economy, get your supply and demand back in level, lower the prime, get rates down. But then you talked about the other one is energy. So it's a separate conversation versus the interest rates and how it works. Does that make more sense?
It makes total sense, but I'm still going to tie it all together in the fact that if I can't buy a house, then I cannot cook my egg sandwich.
That's very possible. But yeah, Jenny, as me and you, we live here in Houston, Texas, in the surrounding areas.
Right.
And as we both know in real estate, it's location, location, location. And I don't care. In here in Houston, Texas, we've been slow as can be. I remember back in 2008, 9, but there was pockets of Houston that always had multiple offers. It's location, location, location. But
Absolutely.
on a general term, if we take it out of Houston, the smaller areas, a little harder inventory. But we're gracious to have a suburban area or an MSA so large that people have to buy a house, and people are still coming to Texas. And our affordable. That's that 250 to 300,000 range is your first time home buyers.
I got it. So, Tara, I want to get your opinion on this because Randy brought up about Houston being a market where we've always had some good areas going on.
Mhm.
Why is Houston such a great market? I can give you my opinion, but I would like to hear from a lending industry why you feel what you're seeing as far as the loans. Are you still writing a lot or is it slowed down?
Well, the one thing about housing is everybody needs housing no matter what the economy is. Okay. So the reason that, to Randy's point, the reason that they utilized the real estate industry to help keep the market alive during the pandemic is because of that constant flow. People are always going to need housing, no matter what's going on in the world. Houston has an economy that is not inflated. We have extremely affordable housing compared to a lot of large cities. And one of the reasons is because of our vast land base that we have. It's not our lots and our real estate ground under the house is not as expensive as a lot of areas in big cities that don't have a lot of places to expand. We have a lot of room to expand in Houston, and because of that, it keeps our housing affordable.
Okay. I like that word affordable because that leads me to my next question for you guys. And either one of you can take this one on. But I want to hear about some of the programs that you guys have in place that can help people purchase those pre-existing homes. Because we hear a lot about new construction and how they're doing their buy downs, but new construction sometimes doesn't offer a buyer everything that they're looking for. Some buyers are looking for a little more character, they're looking for more square footage. Um, some like more of the traditional older style homes. But with higher interest rates, that makes it more challenging. And then, of course, we have to bring up, I had this conversation this morning with the buyer. How do I pay my agent's fees if the seller doesn't pay it? So I would like for you guys to kind of tackle that, how to make that pre-existing home affordable for a buyer.
I'll jump in. So let's. I'm glad you used analysis. If you use the builder analysis to resale, so the builder looks at his community. Individual realtors have been looking at individual selling houses, but if they look at a community level and the sellers look at it from a community level, then they would. So instead of lowering prices, builders don't. They give incentives so they can keep their neighborhood stabilized on a. So it's best, because we, as me and you talk to borrowers, take the contributions versus bringing down the house. You bring down a house $10,000, it's $80 a month. You lower your principal and interest. You take $10,000 today on real fees, that's $10,000.
In your
So
pocket.
we could apply the same concept from the building institution because they're looking at it from a neighborhood standpoint and apply it to the resale, but we got to look at it from a neighborhood standpoint. And we have to use some more, strategy to our homeowners, our sellers, that the new homeowners are coming in. So if they keep the values up, they keep the values up in this times. So that's the strategy, and that's all the builders are doing. It's not magical over there either. They're keeping values up. Instead of discounting the house sales price, they're using those for concessions. And it's smart because they want their neighborhood. They got to keep their appraisals up. If they started going down, the first comp appraisal is the most accurate, most comparable in the time market. And market time is huge. Everybody wants to say square footage, but I mean market, because the best representation of the market, the closest sale, that's the best comp. And that's why it's always number one comp. There's a reason why there's number one, two, and three.
Mm-hmm.
Number one is generally the closest because it represents the market. So looking from an overall standpoint of a 30,000 foot from a realtor looking down, it's best to keep the neighborhood stable because this market will work itself out. And that's the blueprint builders are using.
Okay. So
I want to talk about some really affordable programs, though, also that we've got. People think that they need a lot of money to get into a home, and that's not the case. There are a lot of programs designed for people that don't have a lot of initial funds to invest in a home, but want to become a first-time home buyer.
Absolutely.
We have first of all, government loans. FHA is a very low down payment. VA is no down payment if you're a veteran with eligibility to purchase. And then USDA is no down payment, and they're in target areas that are more rural in nature. And we're lucky in Houston because we're so spread out. Some of our suburbs that you don't really consider to be rural qualify for rural loans.
Exactly.
And then also you can access home buyer assistance. There's a lot of bond programs out there that people will qualify for. Some of them are targeted towards areas of town. Some of them are targeted towards a maximum income that you can make. And we also have some that don't have either restriction that you can access.
Okay.
So there's money out there available, and it doesn't cost a lot to put a down payment on a home nowadays.
So let's play a little game, guys. You guys ready for a game?
Love games.
Okay, good, because I love throwing out little things. So what I'm gonna do is I'm gonna give you guys a buyer. And I would like you to tell me which program you think would best fit that buyer. Who's up for the challenge? Okay. So we have a buyer. They
Oh, sorry. I gotta wait to try the question.
This buyer makes around $75,000 a year, but they haven't saved any money. They don't have any cash, to put down on the property. Now, they could probably get a little bit, but they just don't have it. But they make 75,000 a year. They want a nice home in a good community. And they're trying to figure out how they can afford this house, this, $300,000. Is it doable? And if so, what's the best way for them to go?
You want to do it, Tara? Me
Yeah,
jump in?
I'll be happy to. At that income level, they will qualify for a lot of our bond programs. So even if they're not a veteran and don't qualify for no money down, and they're not buying in a rural area, so don't qualify for that no money down, FHA is a very small down payment, and we can pay the down payment with down payment assistance.
Okay.
So they could literally negotiate their sales contract with a bond loan doing their down payment and some of their closing costs, then have the seller contribute more towards their closing costs and get in for almost no money out of their pocket.
Okay. So what would you say is reasonable for that type of buyer? How much cash on hand do you think would be reasonable for them to have?
Well, let me finish that the in part. So, in the down payment assistant world, to everybody that's watching, the less down payment assist you maximize seller contributions because that's up to 6% of the loan amount, and then the lesser amount of down payment assistance means the lesser rate. So once you and your realtor go out and negotiate what you can get, then now tell us how much down payment assistance, and now tell your rate. But always get as max you can in seller contributions so that we can have the lesser amount of down payment assistance to keep that house affordable. Because there's just money to close, and that's just sort of how it works. More down payment assistance, higher the rate. Less down payment assistance you need, lower the rate. So
Okay.
that's just keep that in mind. So that's why it's important to communicate as we do, all of us, and communication is key in the team that the buyer puts together as you put together, so we can communicate that. Because then the realtor, as you know, Jeneen, you'll know how much you can get. You can know how much long the house is, and then by communicating it back to us, we'll know how much down payment assistance. So we'll know what rate, so that we can advise the customer, this is what your payment's going to be. Because we always want to have a payment that is affordable and
Okay.
set up everybody for success. So, and that's the reality we live in today. You can't go look at a house and then we try to figure it in there. I mean, there's little things that we could do buying down the rate. If you're not doing down payment assistance, then we could have other options. We could use seller contributions to buy the rate down a little bit, but if you got 2 points, that might buy the rate down 50, a half point to 0.6, which in reality is about $110. So it's not, all of it, but if you're doing down payment assistance, you can't use that. But if you're not, then yes, we can use contributions to pay all your closing costs and to buy your rate down.
Okay. So,
And this, I want to do one little commercial here because to his point, that is why it's so important to get pre-qualified. Because once you get pre-qualified, you have connected your real estate agent with your lender so they can negotiate together and get the best deal on the house and also get the house the most affordable for you.
that's why I call you guys before I put my offers in. It's like, what can we do here?
It's
Yes.
so important.
So here's another one. Buyer B makes, 60,000, but they're a really good saver. And so they have 20% down to go on the home because they've always been told, their grandmother, grandfather, mom, dad told them, you got to have that 20%. You don't want to pay that mortgage insurance on there. So they've saved their money. They were really good about that. But if they pay all of that on the home, how does that impact their rate, their monthly payment? Because they want to keep their payment around 1,700. Is it doable?
1,700 on a what sales price?
That's what I'm about to ask you. What's their sales price?
Probably on a $1,700 out, just knowing taxes and insurance, principal. We can go into it, but look, I want to answer that question, then I'm going to forward back to another question. So probably about 220,000.
Okay.
Just depending on where taxes are. But let's go back. So, and I had this customers a lot. So everybody's narrative, I'm put 20% down to 20% down. And I would go conventional. And then if you have a high credit score of 750 or 760, because if you save that kind of money, generally have a high credit score, then I would give them the option of doing 10% down because mortgage insurance has gotten a bad rap over the years. If you have a high credit score, it is very reasonable at a 10% down loan. Let's give you an example. The formula on a 5% down low high credit score would be 0.4, $40 per 100,000. If you jump to a 10% down loan, you can be as low as 0.2, $20 per 100,000. So if you better have, on that $22,000 left on your bank account for $60 a month that you're going to write off because you're under a certain level. Mortgage insurance is, give your CPA, but and ask them. But if you under a certain income, it was like 100 grand, it's tax deductible too. So there's some options, and it's what's best for the customer. I'm always a fan of them keeping their cash. And the reason I am, because if they put it into a house versus their savings account and they come back and say, I want to take some money out, it's going to cost them thousands of dollars to refinance.
Yeah.
Even if you get a HELOC, home equity line of credit, thousands of dollars in fees. So that's always an option I would give them. If they have high credit scores and it makes sense.
Okay. So what's the difference in their rate if they put down the 10%? Not their rate, but their mortgage payment. What's the difference if they put 10% versus 20%? How big of a difference is that going to swing?
Well, just so it's for every 10,000, it's $80. So if that's 22,000, be about $165.
So it's really not a lot of money that they're going to be saving by putting 20% down on it.
No, because the rate's going to be about the same, and now they're going to have a little higher because their loan amount's a little higher, and then they'll have mortgage insurance, and they'll have to make that decision as a family. Are they very comfortable with an extra? It'd be your MI and the lesser mortgage principal and interest would be a little higher because your loan amount's higher. But are they more comfortable having the $22,000 that are disposable at the same time for emergencies as a family? Because once you put that $22,000 in the house, it's going to cost you about 10 grand to get it back out.
Okay. That's a good point. Very good point. I'm glad you've pointed that out. So here we've got buyer C, and this would be the last one. I want to buy a house out in a rural area. I've got a little money, but don't really need to put it down. My credit score is okay. I'm at about a 620 on my credit score, and I can afford a home according to me. I can afford a home because the buyers always know what they can afford. Um, I can afford a home of, you know, 380. That's what I want to purchase. And I'm open to a manufactured home because I want land. Which way am I going to go with that?
Tara?
Um, it being that you're in a rural area, you can go to the Rural Housing Program, USDA, which is 0% down. However, they have target areas and they have maximum incomes that you can make to qualify. Okay, so if you're going too far up in sales price, you would need to make enough money to pay the mortgage payment. And you tend to have somebody that's going to end up exceeding their income limit that's allowed. So most of the time, you're going to see sales prices that are more so around, what would you say, Randy, 250, 275 for rural housing?
Yes, because you can go up to about 90,000 if you have a few children.
Right.
It's the program of the USDA loans. Let's just go with the spirit of the program. It was designed, I think it was back in the 70s, 80s, to people to move out into the rural, and then they can get a little better deal. And it's a separate funded from Congress. It's not funded through our secondary market, which is Fannie Mae and Ginnie Mae's. It's actually a USDA program,
Department of Agriculture.
yeah, Department of Agriculture. So they have qualifying income, they have max loan
Target.
amounts, and they're not helping somebody build a portfolio. So that would be a conversation. I'd love to go USDA if they could, but they're very tight on the ratios of qualifying. But if not, I just roll FHA. In FHA, you can do any loan once you got comps. There's the land to house ratio sort of went away with the air of appraisals, and it's more comparables. Do you have a comparable of this size house on this much land? That's what we're more into versus the land to house ratio. My house is worth 30,000 and my land is worth 1 million. It's not as important. Everybody thinks that. It's more, is there three more houses that are 100 grand with $1 million of land? I mean, that's what we're looking for. Stability and stable.
Okay. So it sounds like you guys truly are the dynamic duo and you have the answers for everything. And you have programs to meet all types of buyers, whether they want to go rural, whether they want to stay in an urban environment, going pre-existing homes. It sounds like you guys really know your stuff and have it down pat and know how to help buyers get into properties that they want to get into.
Well, it takes all three of us, Jeneen. As me and you've been doing it for a
Yes.
while. It takes a village. As as not to be a little cheesy, but we want our buyers, our sellers, our agents, our title company, our appraisers, our surveyors. We all want to be polite and a good experience because they only do this a few times in their lifetime.
Yeah.
So that's what's important.
Yeah, and I agree with you wholeheartedly on there. So I really enjoyed this conversation. I can't wait to see where we go next time when we get back together and we talk through what's happening out in this industry and help everybody figure out how now is still a very, very, and I'm speaking to you guys out there, not to these two because they already know it, but how it is still a great time to buy. There is not a time that I can think of when it was not a good time to buy. You're investing in yourself, and that's a dream that's worth investing in. So, if you have a desire to purchase a home, please reach out to us and let us know because we can help you get that dream accomplished. All we have to do is figure out the right strategy. And that's what we've been talking about is how we can find the right strategy that matches your situation. And trust us, there is one out there for you. And if it's not today, then we're going to figure out how to get you there. So we can talk about that too in some future installments here. But today, I really enjoyed this conversation, Randy and Tara. I love you guys. Can't wait till we talk again.
Thank you,
Thank you
ma'am.
so much.
All righty. Bye, everybody.
Bye.
Thanks for
Bye.
joining us.